You know that specific kind of guilt you get when you sit down to do your monthly budget?
Oh, I know it well.
You're scrolling through the credit card statement, you wince at the grocery bill, which is, I mean, that's painful enough.
Right.
But then you see the pet expenses, and you have this sinking realization that you might have spent more on your dog's organic, grain-free salmon blend than you did on your own dinners for the whole week.
It is a universal experience. We've all been there. We treat them like family, so we spend like their family. And usually they eat better than we do.
Absolutely. My dog has a better skincare routine than I do.
Yeah.
But here's the logical leap we all make, right? We look at that bill and we think, wow, I am spending a fortune. Everyone I know is spending a fortune. So the company selling this stuff must be absolute gold mines.
It's a classic buy what you know style of investing. You see the line at the pet store, you see all the Chewy boxes on every porch, and you just assume the stock chart has to be going straight up.
But in this specific sector, that intuition can lead you right off a cliff.
It really can.
And that is exactly the disconnect we were exploring today. We were looking at a classic retail heavyweight fight. In one corner, you've got the specialist, the darling of the pandemic, Chewy.
And in the other, the absolute Goliath of global retail, Walmart.
And just to ground us, we're analyzing this whole matchup using financial data and market reports from early 2026. We're looking at Q3 fiscal performance, long-term trends, all leading up to February 2026.
So we aren't just guessing here. We have the receipts, so to speak.
The mission today is to figure out which of these two is actually the better bet for the future. Is it the company that lives and breathes pets? Or is it the company that sells dog food 2 aisles over from the motor oil?
Because the answer seems to involve this hidden revenue stream that most people don't even know exists. It really challenges that idea that popularity equals profit.
A beloved brand doesn't always mean it makes money.
Not at all.
So let's start with the setup. We have two very different business models. You have Chewy, which the industry calls a pure play. Break that down for us. Is that just fancy Wall Street speak for specialist?
Essentially, yes. A pure play is a company that focuses its entire existence on one thing. For Chewy, that's the pet ecosystem. They don't sell toaster ovens, they don't sell tires.
Right.
They sell food, toys, meds, everything for pets. Their whole infrastructure, their customer service, it is all optimized for that one specific customer, the pet parent.
Which, in theory, sounds like a huge advantage. If I'm a pet owner, I want a specialist. I want someone who knows the difference between a renal diet and a weight management diet.
From a customer experience perspective, absolutely. It creates loyalty. But then you have Walmart. They are the ultimate generalist, the everything store of the physical world.
Groceries, apparel, electronics, and, yeah, a massive pet department.
Exactly. Specialist versus generalist.
So looking at the macro picture, the industry itself seems pretty healthy. I was looking at the Grandview research data in our source pile, and they're projecting a 5.1% compound average growth rate through 2030.
Right.
5% growth a year. That feels steady. I mean, it's not exploding like AI chips, but it's not dying either. Seems pretty safe.
It is respectable. It proves that this humanization of pets trend isn't going anywhere. People keep spending, even when the economy gets a little tight.
Okay.
But, and this is the crucial nuance that trips up investors, revenue growth in the industry does not automatically translate to profit growth for the retailer.
Why not? If the pie is getting bigger, shouldn't everyone's slice get tastier?
Not if the cost of serving that pie eats up all your money. And that brings us to the single biggest headache in this industry, the margin problem.
Okay, walk me through this. Why is selling dog food such a brutal business? It's just food in a bag. Why is it so hard to make money on it?
Physics.
Physics.
Well, yeah. Think about what you're actually buying. A 40-pound bag of kibble. It's heavy, it's bulky, and, compared to its weight, it isn't that expensive.
Okay.
If you're shipping an iPhone, you have a high-value item, say $1,000, in a tiny, lightweight box. The shipping cost is, negligible compared to the price.
Right. Makes sense.
But if you're shipping a $50 bag of dog food that weighs 40 pounds, you're essentially shipping cement bags. The logistics costs, warehousing, packing, and especially that last-mile delivery are astronomical relative to the price of the item.
That is a great point. I never thought about the price per pound ratio of shipping.
It destroys margins. By the time that bag lands on a customer's doorstep, the retailer's cut is tiny.
How tiny are we talking?
Let's look at the financials. Chewy's net profit margin has been hovering around 2%.
2%. So if I spend $100 on that fancy kibble, Chewy keeps
$2. After all expenses, taxes, operations,
Yep.
roughly $2. And before you think this is just a Chewy problem, look at their competitors. Petco. They are sitting at barely below a 1% net margin.
Wow, so they're practically running a charity at that point.
They are barely breaking even on the retail side. Even a company like Freshpet, which has a slightly more premium product, they're only seeing net margins in the 5 to 6% range. It's an industry-wide structural issue.
That feels incredibly fragile. If you're running on a 2% margin, you have zero room for error. A gas price hike, a supply chain snag, any of that could just wipe out your profit for the quarter.
Exactly, and that's the strategic trap. When your margins are that thin, you don't have extra cash to reinvest. You can't easily build new automated warehouses or develop new tech because you're just running on a treadmill to stay in the same place.
Okay, so that's the pure play struggle. But Walmart sells the same heavy bags of dog food. They aren't magical weightless bags, so aren't they stuck in the same trap?
Well, Walmart's net profit margins are generally in the 3 to 4% range.
That doesn't sound that much better. 3% versus 2%.
On a percentage basis, maybe not, but on a scale basis, it's a whole different world. But more importantly, Walmart doesn't rely on the dog food for profit. They use it differently.
Okay.
But before we get to Walmart's strategy, we have to look at how Chewy is trying to claw its way out of this 2% hole.
Right. The sources mentioned a big pivot into healthcare.
Correct. Chewy is aggressively trying to move from being just a retailer, a box mover, to being a service provider. They are expanding into veterinary care.
I've seen this. They're opening actual physical clinics, right? This isn't just like talk to a vet on Zoom.
Oh, yeah. They have over 20 veterinary practice locations now, and the economic logic is solid. While retail gives you those miserable single-digit margins, pet health services exams, vaccinations, procedures have an average net profit margin of around 20%.
Okay, 20% is a different universe compared to 2%.
Yeah.
I can see why the CFO would be drooling over that.
It diversifies their revenue. If they can get you to buy the food and get the annual checkup there, they can blend those margins and become a much healthier company. Plus, it's sticky. You don't change vets as often as you might change dog food brands.
But here's my hesitation. Changing consumer behavior is really, really hard. I trust Chewy to ship my box on time. They're great at it. Do I trust them to perform surgery on my dog?
And that is the risk. It's a massive brand stretch. And it's not just about trust. It's about execution.
Because building clinics isn't cheap.
It's incredibly expensive. You need real estate, leases, all this medical equipment. And remember, we're in the middle of a massive veterinarian shortage in the U.S.
Oh, right. Trying to hire a vet right now is like trying to hire a pro athlete.
Exactly. So staffing those clinics is difficult and costly. So while the goal is 20% margins, the path there requires a ton of upfront capital. Chewy's playing catch-up. It's a smart play, maybe their only play, but it is slow. It's not an overnight fix.
So Chewy is swimming upstream, trying to build a healthcare empire from scratch. Meanwhile, let's look at Goliath. What is Walmart doing? You mentioned a secret weapon.
They do, but first we have to acknowledge their biggest structural advantage. The grocer anchor.
The fact that they sell food for humans.
Walmart is the largest grocer in the U.S. Think about your habits. You might order from Chewy once every 3 or 4 weeks. Maybe, but you go to the grocery store or order groceries every single week.
Sometimes twice a week if I forget the milk.
Exactly. That frequency is a superpower. If you are already building a basket for your weekly meals, the friction of adding a bag of dog food is zero. You don't have to go to a separate site, manage a separate login.
It's the while I'm here effect.
And that means Walmart doesn't have to spend a ton of marketing dollars to reacquire you. You're already in their ecosystem. Chewy has to fight for your attention. Walmart already has you in the store.
But we still have the margin issue. Even if I buy the dog food at Walmart, they're still making pennies on it.
And this is where the plot twist happens. This is the part that isn't obvious. Walmart has realized that the transactions aren't the only way to make money. They've found a way to monetize the traffic.
You're talking about the advertising data.
Exactly. Walmart has effectively turned into a media company. They are selling ad space on their website and in their app. It's called retail media.
So when I search for paper towels on the Walmart app and I see a sponsored listing for a brand at the top, Walmart is getting paid for that.
They are getting paid significantly. In the third quarter of fiscal year 2026, so ending October 2025, Walmart's global ad sales increased by 53% year over year.
53%. That is explosive growth for a company that size. Usually, Walmart grows the speed of the economy.
It's massive, and here's why investors love it. Margins. We talked about retail margins being 2 to 4%. Digital advertising margins, they're typically 70 to 80%.
Whoa, wait, 70%?
Yeah. Think about it. It's digital real estate. It costs them almost nothing to display that ad. They don't have to ship it. They don't have to warehouse it. It is pure profit dropping straight to the bottom line.
So this changes the whole equation. Walmart can afford to sell me dog food at a razor-thin margin because the moment I open their app, they've already made money showing me ads for soda or detergent.
Precisely. The low-margin retail business acts as the bait to get the traffic. The high-margin advertising business monetizes that traffic. This creates a moat that Chewy simply cannot cross right now.
That's fascinating. It feels almost unfair. Chewy is over there trying to lay bricks and build vet clinics to get to 20% margins. Walmart just flipped a digital switch and is getting 70% margins on ads.
It really highlights the difference between a specialist fighting for share and a generalist leveraging massive scale. They're playing a different game entirely.
So the business models seem to favor Walmart. But what about the price tag? Because sometimes a great company is a terrible stock if you overpay.
Right. We need the valuation reality check.
Let's look at growth first. We have the data for late 2025, early 2026. How do they compare?
In Q3 of fiscal 2025, Chewy posted 8.3% revenue growth.
Okay, solid. Not amazing, but solid.
And in Q3 of fiscal 2026, Walmart posted 5.8% revenue growth.
So Chewy is growing faster. And it's
Yeah.
usually the argument for the smaller guy, right?
They are growing slightly faster, but remember the size difference. But the real story is in the PE ratio, the price to earnings ratio.
For the listener, this is basically the hype premium, right? How much am I paying for $1 of their profit?
That's a great way to put it. A high number means investors expect massive future growth. A low number suggests a more stable, mature company.
Okay, hit us with the numbers.
Chewy is currently trading at a PE of 67.
67. Wow, that implies the market expects them to. What? Take over the world.
It implies that investors are pricing in perfection. They're betting that the veterinary strategy will work perfectly and quickly. It leaves almost no room for error.
In Walmart.
Trading at a PE of 42.
That's actually higher than I expected. I usually think of them in the 20s.
It is higher than their historical average. A PE of 32 tells us the market has noticed the advertising business. They're treating Walmart less like a grocery store and more like a tech platform. But compared to 67, it's still the value play.
We also have to talk momentum. If you've been holding Chewy stock for the last 5 years, you are not happy.
No, the chart is ugly. Chewy stock is down almost 70% over the past 5 years.
70%. That's portfolio destroying.
It's the hangover from the pandemic. During lockdowns, everyone adopted a puppy and ordered online. The stock went to the moon. But that pulled forward years of demand. Now reality has set in.
And the market is punishing them for it. Meanwhile, Walmart is sitting there with a market cap of what, $950 billion?
Versus Chewy's $12 billion?
It really is David versus Goliath.
Hmm.
But in this version, David is shrinking and Goliath just bought a laser cannon.
Or at least Goliath figured out how to sell ad space on his shield, which might be even more profitable.
So let's bring this in for a landing. We started with a question, specialist or generalist? Based on all this, where do we land?
It comes down to your risk tolerance. If you believe Chewy can successfully transform into a healthcare giant, and you're willing to wait years for that to pay off, then Chewy gives you that pure exposure. It's the high-risk, high-reward play.
Right.
But if you look at the fundamentals, the margins, the moat, the valuation, the source material heavily favors Walmart as the better investment for long-term gains.
It seems to come down to optionality. Walmart has multiple ways to win. If pet food slows down, they have groceries. If groceries slow down, they have ads.
Correct. They have the everything advantage. The grocery frequency protects them from downturns. And crucially, they have that high-margin ad engine growing at 53% that lets them generate profits in ways Chewy simply can't match.
And you're paying a lower multiple for a stronger business model.
Exactly. A PE of 42 versus 67. You're getting more safety and a clearer path to profit growth with Walmart.
It's a bit ironic.
Yeah.
As a customer, I honestly prefer the specialist. I like the app better. I like that Chewy sends those handwritten birthday cards for my dog.
The customer service is undeniably better. No one writes songs about Walmart's customer service.
But as an investor, good vibes don't pay the dividend. The ruthless efficiency of the giant seems to be the winning hand.
It's the difference between a great product experience and a bulletproof business model. Chewy has the brand love. Walmart has the economic engine.
So let's recap our deep dive. Point 1. The pet industry is growing, but it's a trap. Retail margins are brutal, around 2% for Chewy, because shipping heavy food is expensive.
Point two, Chewy is pivoting to vet care to chase those 20% margins, but it's expensive, slow, and risky. They're building a physical footprint from scratch.
Point 3. Walmart uses groceries as the hook, but their real profit engine is advertising, which is up 53% and has massive margins. They monetize your attention, not just your wallet.
And finally, Chewy is still praised for perfection with a PE of 67, despite being down 70%. Walmart offers better value and more stability.
Before we sign off, I want to leave you with a thought. We've been talking about pet food and stocks, but this feels like a signal for a much bigger shift.
How so?
Look at what Walmart's doing. They're transforming from a merchant, someone who buys and sells goods, into a platform. They're selling access to you, the customer.
That's a powerful distinction.
It raises a serious question for the future. Can a niche player like Chewy survive solely on specialization anymore? Or does every company eventually have to morph into a services or media company just to stay alive? It seems like just selling things is a losing game.
That is the billion-dollar question. If you can't monetize the attention like Walmart is doing, you have to find a totally different business to be in, like healthcare. If you're just moving boxes, you're dead.
So next time you're checking out, look at your receipt. Where did that pet food come from? And did you buy it because it was the best option or simply because you were already there buying milk?
And how many ads did you scroll past to find it?
Exactly. Thanks for diving deep with us today.
See you next time.